Inflation spiraled out of control, averaging 6.9% for 2022, way above the Reserve Bank's target bracket of 3 to 6%. Inflation has been stubbornly high, but it has begun a downward trajectory, and it's expected to average 5.8% this year. It is expected to edge lower to 5% next year and to reach the midpoint of the target bracket in 2025. The high inflation environment has forced the Reserve Bank to hike rates in a bid to bring it down, putting household disposable incomes under pressure. Between November 2021 and now, the repo rate has gone up by 475 basis points, further squeezing indebted consumers in a high inflation environment and a weak economy where salaries are not keeping up with the pace of inflation, creating affordability issues for many. This translated to higher debt repayments. For example, if you're repaying a 1 million rand home loan over a 20-year period, you would have been paying about 7,900 for your home at the end of 2021. With the rate increases, repayments would have gone up to about 10,800 rand, an increase of just under 3,000 rand.
As interest rates have risen and therefore the installments on that credit also rising, we've seen from the National Credit Regulator that the number of impaired records is starting to rise. What we're also seeing from the NCR is credit applications being rejected. So what you might have been able to afford last year as a credit facility is something that might not be permitted this year, or you would only qualify for a much lower amount than you were hoping to get. So those are some of the direct impacts. And we see that playing out in terms of our vehicle sales. So passenger vehicle sales has really slowed down this year. If you look at the NAMSA figures, we also see just in terms of retail sales, things like appliances, furniture, and hardware goods have seen a contraction in terms of the amount that have been purchased this year compared to last year.
Consumers are advised to continue tightening their belts as the high interest rate environment is expected to be with us for some time.
For those that are finding it very difficult to meet their obligations, the debt obligations, that's the first point. Phone your bank, have a conversation with them, talk about the restructure of your debt. That's the first thing. And then finally, I think from the consumer's perspective, it will be really about cutting back where you can. That is really what the hike in interest rates are intending to do. It's intending to slow things down. And it's painful, but it is the one method we know that ultimately works. It slows demand, and therefore it brings pricing discipline back both on the side of companies and on the side of organized labor. So the best advice for consumers would be as disciplined as you want, as you need to be. Don't overextend yourself, and if you are in trouble, speak to your bank.
Economists have credited the rate hiking cycle for helping to bring inflation under control, further dampening the already weak consumer demand. It's believed the Reserve Bank could cut interest rates in the second half of 2024 if inflation slows and upside risks do not materialize.
There are two things I think are important here. The one is the Fed. The Fed matters. The last year or two has shown us that, and I think that the Fed is probably going to remain on hold for a fair period before it's satisfied that it can start considering interest rate cuts. In fact, we can't say categorically that the Fed rate cycle has peaked yet. I think that will have an influence, especially through global financial conditions and what happens to the rand. The second thing that is important is inflation expectations. The governor mentioned this again today. They are a little bit higher than where the bank would like them. Bank wants them more in line with the midpoint of the inflation target range, closer to 4.5. So I think that the Reserve Bank will probably wait for those two factors to pan out, which does push us later into next year.
The high interest rate environment is, however, good news for those with savings, as they get more interest on their savings. Gloria Tsefakomosi, SABC News, Johannesburg.